On January 6, 2025, something happened in Beijing that most Western analysts completely missed. The People's Bank of China announced a seemingly technical adjustment to its cross-border payment system, CIPIS, the cross-border interbank payment system. The announcement was buried in financial news, overshadowed by headlines about tariffs and technology sanctions. Just another bureaucratic update, right? Wrong. This wasn't a technical adjustment. This was a strategic declaration, one that could fundamentally alter how the global economy operates over the next 2 decades. And here's what makes this fascinating. While everyone in Washington was focused on restricting China's access to advanced semiconductors, Beijing was quietly building the infrastructure to challenge something far more powerful than any chip technology. They were positioning to challenge the very architecture of global finance itself. I'm Professor Jiang Xueqin, and for the next 40 minutes, I want to walk you through why this matters. Not just for US-China relations, but for every country, every currency, and every economy on this planet. Because what we're witnessing isn't just competition between two superpowers. We're witnessing the early stages of a fundamental reorganization of the global economic order. Now, before we dive into what China just did and why it matters, we need to understand what they're actually challenging. And to do that, we need to talk about something that most people take completely for granted, the dollar system. Here's the key number to remember. Approximately 88% of all international transactions are conducted in US dollars. Let me say that again, 88%. Not because every country loves America, not because the dollar is the strongest currency, but because after World War II, the United States built a global financial architecture that made the dollar indispensable. This is strategic, not accidental. When the Bretton Woods system was established in 1944, the dollar became the world's reserve currency, tied to gold. Even after Nixon ended dollar-gold convertibility in 1971, the petrodollar system, the agreement that oil would be priced and traded in dollars, kept the greenback at the center of global commerce. And crucially, the SWIFT system, controlled primarily by Western institutions, became the nervous system of global finance. Think about it this way. If you're a company in Vietnam selling textiles to a buyer in Brazil, you probably settle that transaction in dollars, even though neither country is the United States. Why? Because that's where the deepest liquidity pools are, where the infrastructure exists, where everyone else is already operating. This system gives Washington an extraordinary weapon, financial exclusion. When the US imposes sanctions, it's not just restricting American companies from doing business with a target country. It's effectively cutting that country off from the global financial system itself. Now, China has been watching this weapon being used with increasing frequency and increasing boldness for the past 2 decades. In 2012, the US cut Iranian banks off from SWIFT. Iran's oil exports collapsed by half, almost overnight. In 2014, after Russia annexed Crimea, limited financial sanctions were imposed. Then in 2022, following the invasion of Ukraine, the West deployed what many call the financial nuclear option, freezing Russia's central bank reserves and removing major Russian banks from SWIFT. That was the moment everything changed. Here's what most analysts miss. When the US froze roughly $300 billion of Russia's foreign exchange reserves, they weren't just punishing Russia. They were sending a message to every country on earth. Your reserves held in dollars, your assets in Western financial systems are not actually yours. They're conditional. They exist at Washington's pleasure. From Beijing's perspective, this was a watershed moment. Chinese policymakers looked at those frozen Russian assets and asked themselves a very simple question. If tensions over Taiwan escalate, what stops the US from doing the exact same thing to us? And China holds, as of late 2024, approximately $3.2 trillion in foreign exchange reserves, the largest in the world. A significant portion of that is in US Treasury securities and dollar-denominated assets. This is a decades-long game, and China started positioning for this end game well before 2022. Let me give you a specific example of how this strategic thinking evolved. In 2015, China launched CIPs, that cross-border interbank payment system I mentioned at the start. At the time, Western financial analysts treated it as a curiosity. A Chinese alternative to SWIFT, they said, but SWIFT has 11,000 institutions in 200 countries. CIPs has a few hundred participants, mostly in Asia. It's not a real competitor, and they were right in 2015. But that was never the point. China's strategic calculus here is fundamentally different from how Washington approaches these challenges. The United States tends to think in terms of immediate dominance, build the best system, achieve market share, leverage that dominance. China thinks in terms of infrastructure building, network effects, and positioning for future optionality. In other words, CPS in 2015 wasn't meant to replace SWIFT in 2015. It was meant to create an alternative architecture that could be scaled up when the strategic environment demanded it. And that's exactly what's been happening. By 2024, CIPS had expanded to include over 1,400 financial institutions across 110 countries. Not just Chinese banks, banks in Russia, Saudi Arabia, the UAE, Brazil, Argentina, Iran, Pakistan, and increasingly institutions in Africa and Southeast Asia. The growth pattern is revealing. In 2020, CIPS processed about 135 billion yuan in daily transactions. By 2024, that number had grown to over 500 billion yuan daily, nearly a four-fold increase in 4 years. Now, here's where we get to that January 6, 2025 announcement that I mentioned at the beginning. What China announced wasn't just a technical upgrade to CIPS. They announced 3 interconnected changes that, taken together, represent a fundamental escalation in the challenge to dollar hegemony. First, they've integrated CIPS with the digital yuan, the ECNY, for international settlements. This means that countries can now settle cross-border transactions in a fully digital Chinese currency, bypassing not just the dollar, but also traditional correspondent banking relationships. Second, they've established what they're calling currency swap backstops with over 40 central banks. This is crucial. One of the biggest obstacles to using non-dollar currencies in international trade has always been liquidity risk. If you're a Nigerian importer buying machinery from China, you might want to pay in yuan, but what if your bank doesn't have yuan reserves? These swap lines mean that participating central banks can access yuan liquidity directly from the People's Bank of China. Third, and this is the really interesting part, they've created an automated sanction screening override protocol. In plain English, this means CIPS can now identify when a transaction might be flagged by SWIFT sanctions screening and route it through alternative channels that don't touch the Western financial system. Before we continue, consider this. What China has built is not just an alternative payment system. It's the infrastructure for a parallel financial universe. While everyone focused on whether China would invade Taiwan or how the US would respond to Chinese tech advancement, Beijing was constructing an economic defense system, an offense system. Because in financial architecture, the two are the same thing. The real story is not about payment systems and technical banking infrastructure. The real story is about sovereignty and power in the 21st century. Let me explain what I mean. For the past 80 years, America's superpower status has rested on 2 pillars: military dominance and financial dominance. The military pillar is what everyone sees: aircraft carriers, military bases in 80 countries, the world's most advanced weapon systems. But the financial pillar is actually more powerful, and it's been far more effective at projecting American power. When the US wants to punish a country, it rarely needs to use military force. It just restricts that country's access to the dollar system. This is why sanctions have become Washington's favorite foreign policy tool. Since 2000, the US has increased its use of economic sanctions by over 900%. 900%. But here's the thing about weapons. The more you use them, the more incentive you give your adversaries to develop countermeasures. And that's exactly what we're seeing, not just from China, but from a growing coalition of countries that are, for various reasons, motivated to reduce their dependence on the dollar system. Let's look at some data points from 2024 alone. Saudi Arabia, America's long-standing ally in the Gulf, announced it would accept yuan for oil sales to China. This isn't the end of the petrodollar, but it's a significant crack in the foundation. The BRICS nations, Brazil, Russia, India, China, and South Africa, expanded to include Iran, UAE, Ethiopia, and Egypt. Their combined share of global GDP, measured by purchasing power parity, now exceeds that of the G7 nations. and at their 2024 summit, they announced concrete plans for a BRICS-based payment system. Argentina, despite its new pro-US president, continued using yuan to pay for Chinese imports, bypassing the dollar entirely. Why? Because Argentina is desperate for foreign currency and can't afford to settle in dollars it doesn't have. Russia and China have essentially de-dollarized their bilateral trade. Over 90% of transactions between the two countries now occur in rubles and yuan. Just a decade ago, that figure was under 10%. Here's a question worth pondering. If these trends continue, what happens when 30%, 40%, or 50% of global trade bypasses the dollar? What happens to American financial power then? Now, we need to talk about technology because this financial infrastructure competition is intimately tied to the tech war that dominates headlines. Washington sees the semiconductor restrictions on China, the export controls on advanced chips, the restrictions on lithography equipment, the pressure on ASML and other suppliers as a way to slow China's technological development and maintain American tech superiority. But from Beijing's perspective, these restrictions validate everything they've been saying for years. Strategic industries cannot depend on foreign suppliers, especially when those suppliers operate at the pleasure of the US government. This is why China has poured over $150 billion into semiconductor self-sufficiency since 2020. Will they catch up to TSMC's 3-nanometer chips next year? No. In 5 years? Probably not. But in 10 years? The smart money says yes. And here's the key. China doesn't need to be the best at chip manufacturing to achieve its strategic objectives. It needs to be good enough that the economic cost of total decoupling becomes unbearable for the West. Think about it this way. Right now, China produces about 75% of the world's smartphones, 70% of solar panels, 60% of electric vehicle batteries, and dominates the rare earth processing industry. If China becomes self-sufficient in semiconductors and maintains its dominance in these downstream industries, it's not China that gets isolated from global supply chains. It's the West that risks getting isolated from the physical products that economies and consumers depend on. Let's return to currency because this is where everything converges. The dollar's reserve currency status provides the United States with what economists call exorbitant privilege. The US can run massive trade deficits, borrow at lower interest rates than would otherwise be possible, and print money to finance government spending with less inflationary risk than other countries would face in similar circumstances. But this privilege comes with a responsibility, or at least it used to. The traditional bargain was that the US would maintain open markets, provide liquidity in times of crisis, and act as a relatively neutral arbiter of the global trading system. China's argument, and they're not wrong about this, is that Washington has increasingly weaponized this privilege without honoring the responsibilities that used to come with it. Consider the data. Since 2000, the US has imposed sanctions on more than 40 countries, affecting nearly 1/3 of the world's population. The US trade deficit has ballooned to over $800 billion annually, yet instead of adjusting, Washington lectures other countries about their trade practices. And when the Federal Reserve raises interest rates to combat domestic inflation, it creates currency crises in emerging markets around the world, crises that the Fed barely acknowledges. From Beijing's strategic perspective, the question isn't whether to challenge dollar hegemony. The question is how to do it without triggering a financial crisis that would devastate China's own economy. And this is where that January 6 CPI announcement becomes so significant. What China is building is not a revolutionary overthrow of the dollar system. It's the infrastructure for a gradual, managed transition to a multipolar currency system. A system where the dollar is still important, maybe even the most important currency, but no longer the only game in town. Let me give you a specific example of how this might work in practice. Imagine you're a Brazilian mining company selling iron ore to a Chinese steel manufacturer. Under the current system, you price the contract in dollars, receive dollars, and your bank settles through SWIFT. The US Treasury can see this transaction. If the US has sanctions on either party for any reason, the transaction can be blocked. Under the emerging alternative system, you price the contract in yuan, receive payment through CIPS, and the transaction is settled digitally using the ECNY. The transaction happens in minutes instead of days. The fees are lower because there's no currency conversion, and most importantly, the transaction is invisible to the US financial system. Now multiply that by thousands of transactions across dozens of countries in multiple commodities and manufactured goods. You're not killing the dollar, you're just making it optional. Here's what Washington fundamentally misunderstands about this competition. It's not just about China versus America. It's about whether the global financial system will continue to serve primarily the interests of the US and its closest allies, or whether it will evolve into something more representative of actual economic power in the 21st century. And that's where the global South comes in. The developing world has grown tired of a system where their commodities are priced in dollars, their debts are denominated in dollars, and their economic crises are often triggered by US monetary policy decisions over which they have no control. When Sri Lanka defaulted on its debt in 2022, when Pakistan teetered on the edge of bankruptcy in 2023, when Ghana restructured its debt in 2024, these crises all had local causes, certainly. But they were all exacerbated by dollar strength driven by Federal Reserve policy. China's pitch to these countries is simple. We're not asking you to abandon the West. We're offering you options. Use yuan for trade with China. Use CIPS when SWIFT becomes too restrictive. Join the Belt and Road Initiative to finance infrastructure that Western institutions won't fund. Diversify your reserves. Reduce your vulnerability. This isn't about ideology anymore. This is about practical economics and risk management. And it's working. Look at the data on central bank reserve holdings. In 2000, the dollar accounted for about 73% of global foreign exchange reserves. By 2024, that had fallen to approximately 58%. The euro accounts for about 20%, but here's the interesting part. The yuan share has grown from essentially zero in 2010 to about 3% by 2024. That doesn't sound like much, but in absolute terms, we're talking about hundreds of billions of dollars. More importantly, the trend is clear, and in strategic planning, trends matter more than snapshots. Now, let's talk about something that doesn't get nearly enough attention: the unintended consequences of economic decoupling. Washington's strategy toward China has been increasingly focused on de-risking, reducing dependence on Chinese supply chains, restricting technology transfer, limiting Chinese investment in sensitive sectors. The European Union has adopted similar language, though with somewhat less enthusiasm for full decoupling. The logic seems sound: reduce economic interdependence to reduce strategic vulnerability. But here's what this strategy misses. Interdependence has been a feature of the global economy, not a bug. It's been the glue holding together an otherwise fragile peace between major powers. When US and Chinese economies were deeply integrated, both sides had strong incentives to manage tensions and avoid confrontation. American companies with investments in China, Chinese companies dependent on American markets, supply chains that span the Pacific. These created stakeholders for stability on both sides. Economic decoupling removes those stakeholders. It makes confrontation less costly, which paradoxically makes it more likely. Moreover, decoupling is creating something Washington didn't anticipate. It's accelerating China's self-sufficiency and forcing the development of exactly the parallel economic systems that the US wanted to prevent. Let me give you a concrete example. In 2020, the US restricted Huawei's access to advanced semiconductors. The intent was to cripple Huawei's ability to compete in 5G equipment and smartphones. And in the short term, it worked. Huawei smartphone sales collapsed, but what happened next? China poured resources into domestic semiconductor development. Huawei began designing chips that could be manufactured with less advanced lithography equipment. Chinese companies started buying up every piece of semiconductor manufacturing equipment they could get their hands on before restrictions tightened further. By 2024, Huawei had released smartphones with domestically produced 7nm chips, not as advanced as TSMC's 3nm technology, but good enough for most consumer applications. China's semiconductor imports, which had been growing by double digits annually, suddenly plateaued and began declining. This is strategic, not accidental. Every restriction pushes China further toward self-reliance. And the closer China gets to self-reliance in strategic sectors, the less leverage Washington has. We need to talk about artificial intelligence. because AI is rapidly becoming the ultimate strategic technology, and the AI competition is fundamentally linked to this broader economic contest. The United States currently leads in AI, particularly in the large language models and foundation models that are driving the current AI revolution. Companies like OpenAI, Google DeepMind, and Anthropic are at the cutting edge. The US advantage here stems from a combination of factors: access to the most advanced chips, massive computational resources, top talent, and the best academic institutions. But China is not standing still. Chinese AI companies like Baidu, Alibaba, and Tencent are developing their own large language models. They have some advantages that often get overlooked: access to vastly more data, particularly in Chinese language and cultural contexts, a regulatory environment that's more permissive in some ways about data collection and use, and government support that's willing to pour whatever resources are necessary into AI development. More importantly, China is positioning itself to dominate AI applications in the developing world. Here's the key number to remember. There are about 1.3 billion people in China, 330 million in the United States, and roughly 6 billion people in the rest of the world. If China can develop AI systems that work better for non-Western languages, cultures, and contexts, they can potentially capture the majority of the global AI market. And they're connecting this to that financial infrastructure we discussed earlier. Imagine AI-powered financial services operating through CPS, denominated in digital yuan, optimized for emerging market contexts. That's not science fiction. That's the strategic roadmap. Let's talk about where American strategy is falling short, because understanding these gaps is crucial for understanding where this competition is headed. Washington's approach to China has become increasingly focused on containment and competition. The 2022 National Security Strategy explicitly identifies China as America's most consequential geopolitical challenge. The rhetoric frames this as a competition between democracy and authoritarianism, between a rules-based order and revisionist powers. But here's what this framing misses. Most of the world doesn't see it that way. When American officials talk about defending the rules-based international order, developing countries hear something very different. They hear the rules that we wrote that benefit us, which we'll enforce when it suits us and ignore when it doesn't. Consider the data. When the UN voted to condemn Russia's invasion of Ukraine, 141 countries voted yes, a strong showing for the Western position. But when it comes to implementing sanctions against Russia, far fewer countries have actually participated. India, the world's largest democracy, has dramatically increased its purchases of Russian oil. Indonesia, Brazil, South Africa, Mexico, large, important democracies that are supposedly part of the democratic coalition, have all maintained normal economic relations with Russia. Why? Because they see this as a Western fight, not their fight. And they resent being told they have to choose sides in a competition between two powers that they see as equally self-interested. China understands this sentiment and exploits it brilliantly. Beijing doesn't ask countries to choose. They offer options. They provide financing without the governance conditions that come with World Bank loans. They build infrastructure without lecturing about democracy and human rights. Whether you agree with this approach or not, you have to acknowledge that it's strategically effective. This is a decades-long game, and we're only in the early innings. The dollar isn't going to collapse next year or the year after. SWIFT isn't going to be replaced by SIPs in the next 5 years. American financial dominance isn't going to evaporate overnight. But trends matter, trajectories matter. And the trajectory is clear. The world is slowly, gradually moving toward a more multipolar financial system. What does that world look like? It's not a world where the yuan replaces the dollar as the global reserve currency. That's not going to happen. And frankly, China probably doesn't want that responsibility. Instead, it's a world where multiple currencies play significant roles, where countries hold reserves in baskets of currencies rather than predominantly in dollars, where regional payment systems handle an increasing share of cross-border transactions, where digital currencies, both national like the ECNY and potentially private like stablecoins, provide alternatives to traditional banking channels. It's a messier world in some ways, more fragmented, but also potentially more resilient because it's not dependent on the decisions of any single country's central bank or government. Before we wrap up, let's make this concrete. What does all of this actually mean for businesses, for investors, for ordinary people trying to navigate an increasingly complex global economy? First, currency diversification is going to become increasingly important if you're a business engaged in international trade. Relying solely on dollar-denominated contracts is going to become riskier, not because the dollar will collapse, but because you'll have fewer options if sanctions or financial restrictions affect your counterparties. Second, supply chain resilience matters more than supply chain efficiency. The just-in-time, globally optimized supply chains that dominated business strategy for the past 30 years are giving way to strategies that prioritize redundancy and geographic diversification. That's more expensive in the short term, but less vulnerable to geopolitical disruption. Third, technology standards are fracturing. We're moving toward a world where there might be a Western internet and a Chinese internet, Western AI systems and Chinese AI systems, Western payment networks and Chinese payment networks. Companies and countries are going to have to make decisions about which ecosystems to operate in, and those decisions will have long-term consequences. Fourth, the global south is gaining leverage. For decades, developing countries had no choice but to accept the terms offered by Western-dominated institutions. Now they have alternatives. That doesn't make them anti-Western, but it does make them more demanding and less predictable. So where does this go from here? The optimistic scenario is that competition between different financial and economic systems creates a kind of productive tension. The dollar system improves to remain competitive. Alternative systems grow but remain interoperable. Countries have genuine choices, which forces everyone to offer better terms and better services. The pessimistic scenario is that we're heading toward economic bloc formation, a new Cold War structure, where countries are forced to choose between a US-led system and a China-led system. With all the inefficiencies, conflicts, and risks that entails, I think the reality will land somewhere in between, probably closer to the optimistic scenario, but with significant bumps along the way. Here's what I'm watching for over the next 2-3 years. 1, how many countries adopt the digital yuan for cross-border settlements? If that number reaches 50 or more, that's a tipping point. 2, does the BRICS payment system actually materialize with meaningful functionality, or does it remain mostly rhetoric? The BRICS nations talk a good game about de-dollarization, but they have significant internal disagreements and competing interests. 3, how does the US respond? Does Washington try to maintain dominance through increasingly aggressive use of financial sanctions, which would accelerate de-dollarization? Or does it recognize that some compromise and accommodation is necessary to preserve the dollar's central role? 4, what happens with Taiwan? If tensions escalate significantly, the financial war games become real war games. That would force countries to make choices they've so far been able to avoid. Let me bring this full circle to where we started. That January 6th announcement about CCIP's upgrades wasn't just a technical banking update. It was a signal that China is ready to accelerate the development of alternative financial infrastructure. A signal to countries around the world that there are options beyond the dollar system. And a signal to Washington that financial weapons have a shelf life, and that shelf life is getting shorter. The global economic order that has defined our world since 1945 is not going to last forever. Not because China is powerful enough to overthrow it, but because the world has changed. Economic power has diffused. Technology has created new possibilities. And the unipolar moment has passed. What comes next is still being written. But understanding what China just did, understanding the long-term strategic thinking behind it, is essential for understanding where we're headed. The real battle isn't over chips or trade balances or even Taiwan. The real battle is over who gets to write the rules of the global economy for the next century. And that battle is going to be won or lost, not through military confrontation, but through the patient construction of economic infrastructure and the slow accumulation of legitimacy and trust. China understands this. The question is whether Washington does. Thank you for listening. I'm Professor Jiang Xueqin.